You better prepare for big tech earnings throughout the week and the FOMC on Wednesday. With the administration saying that rates will go lower, and the bond market saying not so fast, Jerome Powell will ultimately be the one who has the final say. And getting the expectations right here should have huge influence over price. We'll actually stream that live on Wednesday. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points to build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we have a mostly solid green-bodied bar here with just a little bit of an upper wick, as we know, coming from that Friday pullback. However, it's not enough to read into from a psychological perspective on the weekly. A strong close from the buyers in the upper third of the weekly range is undoubtedly bullish. If we're thinking about location on the bar-to-bar count, we absolutely have a higher low, as well as a higher high, and a close completely outside of and above the previous candle's range. I would say that the close here is on par with the previous all-time high as well. From a location standpoint, that as well is bullish here. And I just want to rewind back to last week's analysis to drive home the point that as soon as the sellers had failed on the gap down of this green weekly bar right here to produce a gap fill reversal or a lower high on the weekly time frame chart underneath 585, it was game on back to the upside, seeking the equal high to preserve the overall trend. Right at this point, we still have lows. We have higher lows. We know that this was soft higher lows, firm higher lows. This, generally speaking, we were looking for the firm higher low here. There was undoubtedly a bit of an overshoot, but now that we're trading back up at the equal high, it's not fair to call the weekly trend anything other than up at this point. And of course, we can afford another weekly higher low if something like this were to build out and then a continuation move back to the all-time high. Of course, the classic pattern that starts to emerge is some sort of ascending triangle. So the weekly chart is absolutely bullish from a trend count perspective, from a candle by candle perspective. And even if we think about the threat of what was on the table last week before the weekly bar closed, right? We were talking about the potential for a high, higher high, and then, of course, the lower high here building out a right shoulder was the threat. If the sellers were going to make something happen, it basically needed to happen right then and there, push the market in the downward direction, and right, it was not just a one-step process. They would have needed to move back down underneath 585. Clearly, that did not take place over the last week's worth of trade, and as of right now, we are bullish on the weekly time frame chart, seeking continuation in the upward direction. If we bring out a couple of supporting pieces of evidence, we can come in here with the Fibonacci's from the August 5th panic low to the brand new all-time high. This pullback, of course, is still over the Fibonacci 38.2. If we come in from here up to the previous all-time high, obviously, this speaks for itself. We've gone on to produce a brand new high, and we're still maintaining price action over the Fibonacci 38.2. So even if there is a pullback, once again, that higher low is constructive for the uptrend to remain in place. Let's clear that up, and let's take a look at the weekly anchored VWAPs here. And what we'll notice is that we're now back above the entire cluster. We were as of the close from the previous weekly bar, but now we have even more time spent above. Remember, in last week's episode, we said the more time we could spend above the Fibonacci 38.2, primarily from this perspective here. If we could spend more time over this 38.2, the more likely it is that we see the 100% retracement into the zero mark. And of course, that is what took place here. Let's clear that up and let's throw on our volume profile. There's probably not much to glean from this, but we will check in on it. The reason I say that is just because we're trading up near all-time highs. There might be a little bit of a volume shelf that we could break out up and over. Yeah, look at that. Obviously, there's no volume overhead. That would be fresh record highs. But if we can breach this shelf, which just makes sense here around the 608.25 mark, then it's blue skies overhead. If we do see a pullback, I think you have a small volume shelf here that we can pay attention to, and that will be a key daily pullback area, which we'll take a look at right now. Let's drop it down to the daily time frame chart. Let's firstly evaluate this week's expected move. Let's give a little bit of commentary about the expected move here as well, because I think that the market is mispricing volatility. Last week, we absolutely smashed the upper edge of the weekly expected move, And I get it, it was a shortened holiday week. Of course, Monday the markets were closed, but I still think the market should have been pricing in a wider range. And I'm still of the belief that we should be pricing in a wider range here as well. Not only based on a number of the catalysts that are coming up this week, many of the big tech earnings in the Magnificent Seven, along with the FOMC and even PCE inflation numbers coming out on Friday. Obviously, the new administration is changing things up pretty dramatically. So with that, I think volatility is being mispriced here. And again, the point stands, or the point I'm trying to make is just that I wouldn't put too much emphasis into the upper or lower edge of the weekly expected move. I think it's something that we can continue to monitor and track. However, it wouldn't be a shocker if we break that to the upside or break that to the downside, right? With all of these catalysts, just be prepared for continued volatility regardless of what this suggests. So getting back to the point, what is the range of the weekly expected move? If you're not familiar with this study, check out the video tutorial in the top right-hand corner. The upper bound is here at 616.45, implying obviously brand new all-time highs and a higher high in the trend count. The lower bound of the weekly expected move is at 599.67, implying a massive higher low, right? And this gets us into our next topic of conversation, which of course is the daily time frame trend. We just established that the weekly trend was able to save itself and it remains in a weekly uptrend. Well, the daily time frame chart is now in a daily uptrend, and the reason I say that is although we don't technically have a higher low on the table yet, instead of just breaching and producing a higher high from here to here, which we did as soon as we opened up on Tuesday morning, we've actually made new record highs, right? So although yes, we are still coming from the lowest low in the trend count, there has been no hourly change in trend to produce a firm daily higher low. I'm willing to go out on a limb and call this a daily uptrend with the move to make a brand new record high, of course, on the Thursday breakout as well as the Friday move in the early morning session. So with that, the daily trend is up, which means, of course, sitting on the highest high in the trend count, we, of course, can afford a higher low on the daily time frame. And where might those higher lows want to form? Well, the first one that seems the most obvious to me is just the gap close off of 603, right? If the market comes in here, closes the gap, finds buyers, and then moves back into blue sky territories, rock and roll. That's a huge opportunity for a massive higher low on the daily time frame chart. It's well within the bounds of the lower edge of the weekly expected move as well, which again is just a suggestion considering all of the volatility components this week. But 603 makes a lot of sense, right? It's a gap close. It's the previous record, not record high, but rather previous lower high from here. That's the gap close. And it's also the bottom end of this previous balance range, right? It's the origin of the Powell plunge from back over here that we got in mid-December. So staying over 603 is absolutely bullish, and I would be looking for long opportunities to set up some sort of risk and then reward back up towards the all-time high. That's the range that we would, generally speaking, be looking to exploit, right? And then beyond that, we can balloon runners up towards a blue sky breakout. If the market moves underneath 603, it's not the end of the world, right? We can still seek some sort of daily high or low. I would say if we do something that looks like this, I would be highly interested in potential support off of basically 600. The lower edge of the weekly expected move is confluence with this level. And again, maybe we trade this as something that looks like this, back to the all-time high, and then Brigade bolts here. That's absolutely fine. The reason this is the most important, maybe not most important, but it's a substantial level beyond the gap close is because it represents the previous lower high in the trend count, right? The trend was down, and we had this equal high here via the inverted hammer on the Friday session of now 2 weeks ago. As soon as we took that out, that's now the key area of support. We really want to see previous resistance act as newfound support. And once again, that's 599.65, 600 flat. That general zone is where I will be looking for buyers to step up for the next opportunity of a higher low. If you're a little bit lackluster on the confidence front here for that retest, just understand that the Brigade bolt back over 603 can then set up a similar opportunity to the first higher low pullback we discussed here, where you're basically looking for the same continuation of the trade. You could say risk and then reward coming off of a more firm daily higher low at that 600 figure. I would start to become not dramatically concerned. Let me frame it that way. I would not be dramatically concerned if we're underneath 600, but I would start to become a little bit more so on edge about the markets, just being a little bit more diligent about my positions, my position sizing primarily, because if we move underneath 600, we're just going to use that as the round figure. If we see something that looks like this, although, yes, we can technically get support off of, the 50 SMA, this additional gap close over here, I do have a small concern about then producing some sort of lower high back down underneath, namely 603. Now, I don't want to jump the gun, right? We can clearly see that there is market momentum here. We had the CPI gap and go on that Friday session. We had a gap up on Tuesday. That gap closed. And then we had the gap up on Wednesday. That has not been filled either. So if we're looking objectively at the chart and ask ourselves the question, if we ask, do we have stronger sellers involved in this market? The answer is absolutely not. I think that, again, this is a little bit premature to try to call that there's going to be some sort of lower high opportunity here, but I think it's something that we just want to have as a possibility, right? If we remain flexible, then it shouldn't be a surprise if it does end up happening into the future. So not calling for this, but that would be why I'm less thrilled about a potential higher low forming underneath 600. I think it leaves the door open to a potential lower high on the back test of 603, which then just keeps the markets back down inside of this balance range, which gets, once again, neutral, annoying to trade, right? Choppy. We're not going to be making any bold calls in there. We won't be heroes in the balance range. All of that stuff comes back up to the top of our analysis, right? So that's the daily time frame chart here. I do want to take a brief glance at the Fibonacci from the bottom of this move up to the top of this move. We did something similar on the weekly chart, right, when we were just inverting it basically from the election move to the all-time high. But notice that the 38.2 is sort of right around that 50 SMA in here. So once again, is it possible that you could still seek a higher low on this gap close near the 38.2 on the rally thus far? I think the answer is still yes. And I mean, obviously from a trend count perspective, it's still a huge higher low. So we'll remain bullish on the first test there, but we just want to keep an open mind to what that 603 holds when we're trying to make that advance back towards the all-time high. The last thing we'll do on the daily time frame chart is actually grab even more time here, and I just want to compare this rally to what we had in the late stages of 2023. It was the lockout rally after this more dramatic pullback in the autumn of 2023, right? So here's October. This is a gap and go, another gap and go, gap and go. And what I really want to highlight through this zone, and you can go and you can study this, right? You can take some time and really read into the price action here. But when we got this consolidation here, notice that the gap low was never taken out. And as soon as we went on to make new highs, that leads to continuation in the market. You'll also notice here that volatility did end up drying up. Notice that the ranges of these daily bars are quite small as we made this advance. So just understand if that we start pushing into new all-time highs after holding up over the top gap that we have on the chart, then I would expect that, okay, maybe the options market is getting it somewhat right. I'm not a believer with all of the catalysts we have this week, but if we can get through that, if we can get through the catalyst, the chart remains looking something along these lines, don't expect a huge amount of volatility as and if a lockout rally grind continues into brand new record highs. So once again, I feel like as though we're in the situation of somewhere in here, and one thing you can pay attention to is just the simple every single daily bar produces a higher low. That's known as one time framing. In here, as long as we maintain that gap low, we're all set. And once again, if we make the comparison to where we're at currently, let's just jump on over to recent price action over here. Notice that every single daily bar since the low is producing a higher low. We have this lockout rally in effect as long as we stay over this gap range right here at 605.35. The premise should be that we do not have stronger sellers in the market. We will seek upside. Now again, is that a high probability of unfolding? I'm not convinced because we have a number of catalysts on the horizon that we'll start talking about in just a moment. So you know my daily game plan. Let's knock it on down to the hourly time frame chart here. Again, we can just simply see the gap and go, the gap and go, the gap and go. Even intraday, when we have a little bit of a balance, a little two-sided trade, it's not like we're seeing aggressive sellers push to at least even test the prior day's low. And I would just reinforce this as of the Thursday open, right? If the Thursday open is indicative of anything, that's where the sellers had the potential for what I consider the gift, right? And the gift just means that sellers finally have an opportunity to have overhead supply. Value area on Wednesday is actually over where we opened on Thursday. So in theory, if we had sellers who were actually going to push the market lower more aggressively, they should have yielded a lower high under the value area and at least attempted some sort of gap close here. Obviously, that was not the case. That did not happen. We rally and we actually produce an end of day spike, which is starting to get rejected on the Friday session. We'll talk more about that in just a moment when we get to the market profile. But for the forward outlook this upcoming week, I think it's very straightforward. Any consolidation here is exactly that. It's bullish consolidation until proven otherwise, based on the one time framing and the lockout rally example that we just looked at on the daily time frame. Beyond that, Brigade bolts here, of course, get interesting. And if you want further confirmation, it would just be a higher low over the all-time high, which is technically at 610.85. So this is like primary situation number one. Of course, is it possible to trade shorts here if we move into the gap? Absolutely. If we get this same consolidation in here, but instead of breaking over the previous all-time high, and you can see the small consolidation open from the Friday session, if we break to the downside, then yes, naturally on the hourly time frame chart, I'm sure the pattern traders are shouting from their chairs right now, yes, we have the head and shoulders. Yes, we have a high. We have a set of lower highs. If we breach this and move into the gap, then default, right, de facto, we have a lower low. I will be seeking some sort of gap close. And you could take that as a trade. That's fine. You could trade short from point A to point B, but I would not overstay my welcome at 603. As we know on the daily analysis, that's really where we're looking for a higher low. So if we get this consolidation, here's your sort of short trade, then I would change tone and say, where's this? Where's this? And where is this for continuation in the upward direction? You want longs here, you want longs here, and you would like longs here, ideally seeking that continuation for a blue sky breakout. That would be an ideal hold for a daily higher low off of 603. As we mentioned, we could also get a higher low at 600. So if we see continuation beyond this, again, it's okay. You could try to trade this short. You do, like if you wanted to go counter trend to the daily time frame chart, there's nothing saying that the hourly cannot produce a pullback, right? If we get this, rejecting this all-time high breakout, we have the hourly lower high, we get the lower low, fine, right? The next thing you would look for confirmation is another lower high underneath 603. But again, what would be my personal thought process here? How can I align with the daily time frame chart to set some sort of higher low? Do we get this? And I'm just drawing in these inverted head and shoulders. It could be a double bottom. It could look like a simple hammer candle. It could be any sign of a bullish reversal off of 600 or off of 603. Those are the two key levels, and that's how I'd really look to trade this early on in the week ahead of the FOMC. Now is a good time to just talk about how if the FOMC comes around and Jerome Powell says something that the market is totally not expecting, then obviously the technicals will not hold up. And the best example of this is just the Powell plunge from the December timeframe, right? If we look back here, technicals didn't matter. Jerome Powell basically said, hey, we're going to hold rates higher for longer. You might not even get the second rate cut in the new year. And boom, markets went straight to the downside without regard for technicals, right? You could say that it was the acceleration under the balance lows, and that's fine. But the point I'm trying to make is that we have our game plan for the move ahead of Wednesday, and at 2 o'clock on Wednesday afternoon, the game plan is reduce risk, be comfortable with all of the positions you have on if you're going to hold something through Jerome Powell, because technicals go out the window, and if he says the right combination of words, the market may go haywire. Now, we'll get more about this, or we'll talk more about this when we get to the fundamental section of the video, but the market's really been moving on what I would consider, towards the end at least, let's say the Wednesday rally, which of course has a lot to do with the Stargate announcement and the semiconductors moving higher. It's almost been running on fumes here for the past couple of days. And the reason I say that is we can actually transition now. Before we get to internals, let's take a look at the intraday anchored VWAPs, right? You can see these things all anchored from the bottom and the gap ups that we have in here. If we start to breach this, I would tend to think that this 603 makes sense. This is kind of confluence around that 600 as of right now. So there's the anchored VWAP spread. And primarily, once again, I wouldn't be thrilled if there's a move underneath 600. However, with the 50 SMA and confluence out of this anchored VWAP, as well as the previous all-time high anchored VWAP, that's this back here. It's gray. It's a little dimmer on your screen. It's right there. I would say we can still seek a daily higher low around this area, right? Which really doesn't, we discussed that on the daily time frame chart anyways, right? Although it's still technically a higher low, we're just concerned about the 603 retest after that, right? One step at a time. Anyhow, what I was talking about was that the rally was starting to move on fumes, right? So the reason I say this is if we take a look at the market internals here, we really did not have substantial volume inflows on the Thursday session nor on the Friday session, right? So is it really fair to say that a ton of people are getting bullish and big money's flowing into the market these 2 days that we try to make this advance? Not really. And even on that Wednesday gap up, I think this is really noteworthy, we had volume outflows from the market. So that doesn't really add up as looking like the most bullish picture I've ever seen. If we look at this over here on the advanced decline line, none of these days, Wednesday, Thursday, or Friday, made it into trend higher zone. If we look at the cumulative builds out of the tick, Wednesday is actually negative, Thursday is negative, and Friday closes flat. So one more time, when I say that the market's kind of moving on fumes up here at the highs, price is ultimately what pays. And if we see a downtrend develop on the hourly, I think it makes sense to try to short something through the gap fill and then maybe look for new buyers at 603. But the downside is extremely playable there, in my opinion, based on what we can see in the internals. And if you're looking at this and you're saying, Matt, you just told me about a lockout rally on the daily time frame chart. There's no way in heck that I'm shorting this market. That's fine, but another way to interpret this might also just be like, hey, maybe it's not the best idea to be fishing for brand new money longs if we just get continuation out of this move and the market internals continue to not really support what's happening with price, right? So that's sort of a, keep in mind that your trade location at the tippity top of the move here is not really the greatest. Let's take a look at the market profile where there's additional, clues we can look for that start to tell us quite a bit. So first and foremost, I think the main focus should be the spike from the Thursday session, right? The spike is basically a late day price movement that is not confirmed because the market closes at 4 o'clock. So on the Friday session, we technically open in the spike range. This, triangle, I doubt you can see it on the screen. This triangle represents the opening price. So we open in the spike range, which means from a spike rules perspective that we will look for some response off the spike high or the spike base. If we move over the top of the spike, which is basically just the equivalent of the Thursday high, we should seek continuation in the upward direction. Now, if we just look at this chart and based on what we just talked about from the daily looking bar, obviously the hourly chart as well, was there much acceptance over the top of the spike? The answer is absolutely not. I mean, the point of control is underneath. Yes, value is overlapping, but generally, where did we close? We closed down here, as we know. That's actually underneath the spike base, right? So the more I look at this chart, the more to me, again, it seems as though the market's running on fumes towards these higher highs, and you just want to be thinking twice about big new money long positions if you're taking like a multi-day approach. Now, of course, these are reference points when it comes to scalping, but the multi-day approach, does the market have more gain to be seen in the upward direction over the next 3, 4, 5, 6, 7 days? It certainly seems like a pullback would not be unreasonable based on these data points. The next thing to just point out is that the low, of course, from the Tuesday and the Wednesday and Thursday, my apologies, is mechanical, right? It's precise. It's the exact same level, and this is even a poor low on that Thursday follow-up session. So what does that mean? That's a weak level. If you test this, you should probably expect a breakdown through that to at least close the gap, right? Which totally aligns with the analysis that we just conducted on the daily and hourly time frame charts anyhow. So let's get back on over to the platform here. Let's flip on over to our good old friend, the QQQ nasty NASDAQ. Let's jump this thing up to a weekly time frame chart. Let's switch markets and take a look at what's going on from this perspective, starting with candle structure and location as we always do. S&P, probably, I shouldn't say probably, but not unreasonable for a pullback. Let's see what the NASDAQ has for us. And we know the higher low levels as well. That's really what we just spent the most time analyzing. If we take a look at the NASDAQ weekly bar, we have a green-bodied bar, a little bit more of an upper wick and lower wick relative to the size of the candle body, especially when we compare that to the S&P 500, but nonetheless, still a decent close from the buyers in the upper third of the weekly range here. It's a green close if we're thinking about the bar-to-bar count. Of course, a higher low as well as a higher high and a close completely outside of and above the previous week's range. Now, of course, the obvious thing here is just that there is a divergence between this and the S&P 500. We did not generate a brand new record all-time high in the NASDAQ, whereas the S&P 500 did. And this is primarily, in my opinion, due to the strength we've seen in financials. And we'll talk more about that when we get to the sector breakdown. But if we're thinking about the weekly trend here, I really just fall all the way back to this data point, which we've been talking about until we're blue in the face here on the channel. It has been nearly impossible to have a longer time frame outlook, short opinion on the NASDAQ as long as we were above the previous all-time high here, which was 503.25. That has ended up being a blessing because man, oh man, did we test that level perfectly and move exactly in the opposite direction, forming nothing more than a weekly higher low. And you can go back, you can watch the weekend videos, you can watch the Wednesday videos. We've had this stance for a very long time, and it's finally been paying off here, right? We did not want to get prematurely bearish, and of course, that again has been the proper call. So now the idea is with the higher low, can we produce some sort of equal high? Can this play catch up to the S&P 500? And with big tech earnings this week, I do believe it's possible. Again, it's within the realm of possibilities. Am I saying we need to move higher on earnings? Well, if Netflix is anything of an indication, then I would think the season is off to a good start, but we don't want to make a decision just based purely off of one announcement. And anyways, as traders, right, it's very, especially as options traders, you don't want to hold short-dated options through earnings announcements. You will get crushed on implied volatility. So we'll get to that when we get to it. But the weekly chart here looks constructive. It looks bullish out of the NASDAQ. I'm not as worried about a potential lower high. If that was going to happen, just like the S&P 500, I would have imagined that some rejection right around this level. You can see the upper wick from that previous inverted hammer, the top of the red bar. It should have been basically right off of the open. Send it back lower. Now we have a weekly lower high. I'd say this is much more on track for producing that equal high, as we've talked about now for the last couple of minutes. If we come in with the Fibonacci's, all of it taking place over the 38.2 from the election low to the all-time high, spending more time, another week over the Fibonacci 38.2. If we come in with our anchored VWAPs on the weekly above the entirety of the cluster, using it as support in the lower wick from last week's candle. Very bullish here on the weekly time frame chart from these additional perspectives. Let's check in on the volume profile, which might actually have something to tell us, considering that we have not pushed for that record high yet. Zooming in, do we have a lot of resistance volume-wise at the all-time high? The answer is no. And the volume shelf really is right at the high of last week. So if you breach last week's high, I would think that the door is open for continued upside and seeking some sort of blue sky breakout. Let's drop it down to a daily time frame chart, evaluate the weekly expected move, and then we'll keep this show on the road. What do we see here? Weekly expected move, and once again, mind that the volatility is likely mispriced with the big tech earnings, but 540.15, and then we have 519.10 down here. Generally speaking, I think it's a mispricing totally. If I'm thinking about the trend, it's back to the upside, right? Or maybe I should even say neutral here, starting to flip to up, right? Where you have lows. This is not really an hourly downtrend. I'm not a believer in that as being a higher low here, and it's primarily because this lower wick is false. We corrected that on Wednesday, but it looks like it's not holding. And then it's just been nothing but up, and away. We have a balance range up here, but definitively, right, into the end of the week, one thing that is quite nice is that we are holding higher highs, and the bottom end of this balance is right off of the previous high from back here. So as long as that level, which is really at 528, continues to hold true, I don't think that we have any, indication of stronger sellers. If we did, really on the gap down open on Thursday, that should have resulted in the gap closing. On the test underneath Thursday's low from Friday's opening end of day flush there, midday really, it should have continued to close the gap, right? Now, obviously that did not take place, so we're really left with more of a 3-day balance range here over the top end of the previous lower high in the downtrend, right? We had highs, lower highs, lower highs. It was possible that this could have set a lower high. That did not happen, so we do have the higher high as mentioned, and we are starting to drift into a QQQ daily uptrend, but unlike the S&P, without that brand new record high, I would probably say I would be more confident in this daily uptrend sticking if we can produce now some sort of higher low, which would, in my opinion, just need to be over this 518.50. We really don't want to see price all the way back down here out of the nasty NASDAQ, right? So 518.50, lower edge of the weekly expected move, daily 50 SMA makes a lot of sense for potential support. Of course, daily gap fill reversal up here that moves back to the high should indicate some sort of push through these equal highs. It's the improper end of the auction, just like we talked about in the S&P 500. And if we can get that break, obviously, you're looking for the all-time high. That's at 539. So the daily chart is quite clear. We have a 3-day balance range. If we break the 3-day balance range in the upward direction, a range double brings us to the all-time high, all set from that perspective. And a range double to the downside probably brings us slightly lower than the gap close, but still seeking some kind of higher low opportunity. There's even a nuanced level at 523 in here. Let's take a look at the hourly chart just so we can see that. And reason we have 523 is because of the high of day from the Friday session of now 2 weeks ago, right? So if we can hold up over that, it's a great opportunity. If we can get this, right, which has already seen previous resistance, act as newfound support above it on that Tuesday session, right? It's that 518.50 level we were just describing, all set from that point of view. In terms of, one more time, getting really granular and reading into the price action, I did this a little bit on the daily time frame chart, right, where I said, hey, on the Thursday gap down, if sellers were going to be here, it should have moved through the gap. Didn't happen. You can see that there's the lower wick there that marks the low of day, and that's it. On the Friday session, right, notice that we break midday, mid-afternoon, underneath the low of Thursday. Do sellers accelerate? The answer is absolutely not. It would have been much more bearish if we closed under the Thursday low, giving some sort of daily bearish engulfing bar once again. That has simply not taken place. So although in the S&P 500 we've identified that maybe we're running on fumes up here towards the highs, we also don't have sellers who are really compelled to push price aggressively lower, right? There is no hourly downtrend here, which brings up the next point, which is just the trade thesis. If this is going to turn into an hourly downtrend, then of course, you're just looking for price acceptance under the neckline of what could be construed as a double top. And of course, the gap closes the target. 526 is where we're seeking a higher low from the daily perspective, some sort of move that looks like this, and then up to the all-time high. If we get a deeper pullback, I would certainly entertain opportunities here off of 523, then possibly a higher low back above, and you could do the same thing that we basically did in the S&P 500, walking up your higher lows. The name of the game is to look for the higher low to align with the daily solidification of the uptrend we are now starting to form. And once, I know that everybody is like, every level's a higher low, every level's this, it's true. 518.50 can offer a daily higher low. Will there potentially be short opportunities to be had underneath this? Could you short from, let's say, like point A to point B? You could try it, be my guest, but based on all the evidence I've seen thus far, right, it makes sense to only be short tactically, being short for quick moves to close the gap, reevaluate the position here. If it breaks for a lower high underneath, great, you could try it again. Another short, close up shop here, tactfully, sort of reassess, do we have stronger sellers persisting under 523? Great, try it again here. When we get to each of these levels, though, the point being is that you want to reassess to see if the daily time frame chart is going to catch that higher low. The DHL shipment is here. It's potentially upon us. And again, earnings season has the possibility to cause some volatility here, but the primary objective should be to seek the higher low. Let's go back to the hourly just so I can show you the anchored view apps intraday. And what we'll see here is a lot of confluence right around that 518.50, which is why it is the daily line in the sand. We do not want to see price underneath that. Otherwise, with the daily possibility, or maybe even at that point it's weekly, with the weekly possibility of a lower high, I would be more concerned if price starts trading again down here towards the bottom end of the range. Now, once again, not to overuse the word again, but I would not aggressively be a bear here, right? And again, you can get frustrated in the comments. That's fine. If, there's a number of folks who are like, this guy's the perma bull of YouTube. Fine, whatever. If we're over the previous all-time high, I'm still not going to take that aggressive stance to the downside, but I will absolutely think twice about longs in here if we're not holding 518.50, right? So that is the name of the game through the time frames here on the nasty NASDAQ. Let's quickly take a look. I just want to be very congruent in the analysis here. I do want to take a look at the lockout rally. And this, of course, a lot of this move was fueled by AI, right? If you take a look at the, where is it? Geez. We want the late stages of February. Here it is. Zoomed a little bit too far back, but look at the lockout rally. It's the same thing, right? Where every single day is one time framing in the upward direction. There is no lower low underneath the previous candle's low, right? Everything's higher, gap and go, gap and go. So just be prepared that if the market does not give you any sort of breakdown to close the gap, if we just see consolidation in here and a move higher, what's the market shouting, right? It's shouting that we do not have stronger sellers. So anyhow, continuing to take that into account here when dealing with the NASDAQ. Let's look at our internals, see if this is running on fumes like the S&P. I would say it tried to be a little bit better on the Friday session, but once again, not really the best display of strength through the move on Wednesday and Thursday primarily, right? You can see that, yeah, we had volume inflows, but they were not substantial. Same thing on Thursday. Friday actually reverses. For a majority of the day, this uptrend was actually counter to the morning breakdown, right? Same thing happening here. Same thing with the first attempt to hold a positive tick on Friday. But point being is that, yes, the market internals actually align with the idea that this rally is sort of running on fumes, and it would not be unreasonable to seek the higher lows, right? It would not be unreasonable to look for the gap close and then a reversal. It would not be unreasonable to look for 523 here on the QQQ. Let's quickly check in on the market profile of the NASDAQ, and I'm just realizing now that I have not pointed you to the tutorial. So if you want to check out market profile, check the tutorial in the top right-hand corner. We'll do the same thing for the internals in just a moment. Notice that your spike here did not produce a new record high like what we had on the S&P 500. It did not take out the previous day's high. That's why we're not seeing that head and shoulders style look on the hourly. But nonetheless, we still opened right at the high of the spike here. This is Friday's open in the triangle. Again, I'm sure you probably can't see that, but that's the open. Not much time or acceptance above the spike. If we extrapolate the spike base, point of control did close over the spike. Value area is overlapping to up, but the daily close is still underneath that area. Once again, in my opinion, it doesn't look like we have stronger sellers. We moved underneath the previous day's low. No follow through. Moved underneath the previous day's low. J period, decent excess down there. It's not a poor low. That to me looks much more much more refined in terms of the proper end of the auction at the low end of the balance range we're dealing with. In terms of how precise these highs are, not quite all the way there on the Friday session. So I would not count that as mechanical. Definitely have more of a mechanical setup over in the S&P 500. Let's jump on over to the IWM, and just FYI, I'll put this up on the screen now for anyone who's curious. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner right about now. All right, IWM cash ETF, what's going on with the small caps? Weekly time frame chart will kick things off, and we will see what we can see on the small cap weekly. Where are we? Here we go. One more time, folks. I really appreciate it that you stick with me here as I'm adjusting charts in real time, moving from chart to chart. So thank you. With that, IWM weekly time frame bar. What's the candle structure? What's the location? It's compelling, but not compelling at the same time. Reason I say that is structurally we have ourselves a inverted hammer. There's been a lot of discussion in the comment section as well about like people saying that's not an inverted hammer, that's a doji, that's not a solid green-bodied bar, that's a this, that's it. It's a green-bodied candle with an upper wick, which indicates that we have stronger sellers at the top end of the range who push price lower and close probably towards the midpoint of the range. I don't care what you call it, but at the end of the day, it indicates the same thing, right? We have sellers stepping up at the top of the range. So at first glance, it's like, that's not really the greatest looking structure in terms of the individual bar. But if we add in some context, which is really why I started with this white horizontal line in the first place, the location of this candle is somewhat compelling, right? We have lows, we have a massive higher low completely outside of and above the previous week's high, and of course a higher high to go with it and a close outside of and above the big weekly breakout level. So is this a step in the right direction for the buyers? Absolutely. Absolutely. We have to give credit where credit is due. Small caps are starting to look like they might do something here if they can stay over. Again, it relies on continuing to stay over the 227 mark. And of course, being very sensitive to what Jerome Powell has to say on Wednesday, we'll keep an open mind to things changing. But for now, a good step in the right direction. Let's quickly take out the Fibonacci's from the August 5th low up to the high. Back over the 38.2, we know that that's been confluence. And if we bring out our anchored view app spread on the small caps, this is where, again, it's a little bit of that push and pull. The candle structure, inverted hammer, which is technically bearish, near the anchored VWAPs, if it breaks the low of last week's bar and falls into here, I would probably change my tone back to being much more of a headwind, at least, small caps acting as a headwind for the S&P 500. So 227 really holds the key, and it seems reasonable that if we take out that low, after clearly seeing that seller stepped up towards the high of last week's range, it would seem reasonable that that's a possible outcome this upcoming week. So keeping a very close eye on the small caps here into the coming week's worth of trade. We know that there's not much to glean from the volume profile perspective, and we actually have to do the opposite here. We have to grab even more time, and we have to take a look at this high volume node. It is still technically underneath us, right? Obviously, if we were to clear the entirety of the shelf, it looks like that's actually right towards the highs of last week's move. So over the high gets interesting from a volume perspective, but under the low is kind of detrimental from a structural perspective. Let's drop this back down to the daily time frame chart. Let's firstly evaluate the weekly expected move. What do we see in the gray box right here? We have ourselves 233.77 and 223.62. I like the fact that this, of course, implies a higher high. This does imply a higher low from here to here. However, it is underneath that also dangerous level at 227. So for me, not as worried about the lower edge of the weekly expected move, more worried about does this hold above 227 and can it rally in the upward direction? Can it get towards the origin of the Powell plunge the first time around, which is closer to 230.85? We are getting a little bit of a pinch right between the daily 50 SMA and the level. So I would just treat this as a 4-day balance range. If you wanted to get really microscopic and granular here, as a matter of fact, let's just do it on the hourly. You could say that, and you can see. So I will say, and we will see, that we technically took out the top end of the range here on Friday's, mid-morning push, and then we failed back down into the 2-day range at that point, right? And because of that, it might not be unreasonable for a full test of 227 again after having tested it once, twice, maybe 3 times here after failing to move outside of the previous 2 candles highs on the daily, right? Then not really in love with the idea of trying to buy 227 in search of some sort of launch back to the upside. Really, for me, and you do whatever you want with these levels in the analysis, I use this as a bellwether for the S&P 500. So to me, I'm not going to be actively seeking longs here, but if I see that buyers are starting to step up, it might influence some more confidence, inspire some more confidence to be long in the S&P 500 versus if it starts to break down, if I notice that prices are trading, 226.85, 226.50, 226.15, I'm going to be a little bit more concerned about that S&P, which sort of aligns with the pullback running on fumes idea that we just mentioned anyhow through that analysis. So that's sort of what we have out of small caps. The last thing I'll do here is just come in from the top of the Powell plunge to the low that was made in this move back here. And we are spending time over the 61.8. It's not great confluence with the weekly level at 227, but it is sort of within striking distance. As long as we're above that, the more time we spend above, which as of right now, a decent amount of time has passed here, the more time we spend above, the more likely it is we see that rotation into the 100% retracement, once again, closer to 230, 235 on small caps. Let's go back down to let's actually go to the hourly chart here. I do want to pop in the intraday anchored view apps just to give you an idea. There's a decent amount of confluence if we think about where these things will slowly start to converge upon at the 227 level. So the more time we go sideways above the level, the more that these will continue to offer some support as they grind higher throughout the week and meet us there for super support. I really think, again, it's a very simple watch out of small caps. 227 is the main level. So with that, we'll take a look at the market internals for the Russell side of things. And I'm realizing, again, with my little pointer for tutorials, I don't think I said check out the video tutorial for internals the first go around. So there it is. If we're looking at the Russell, I think it's a rinse and repeat, right? Are we really seeing strong buyers step up to keep the consolidation in the last 4 days over the top end of the balance range? Not really, not really, not really. This is actually mostly negative, and the cumulative builds look kind of horrendous, notably that Wednesday session. So am I thrilled about this action? Again, the weekly competition with that upper wick, what we can see here at the internals level, with the failure to break out on the Friday session after, moving over the 2-day highs, it wouldn't be shocking to me to see some sort of test early on of 227. If it holds above, then great. We'll give credit where credit is due, but if it breaches, don't color me surprised in terms of that as a possible outcome for the market. Let's check in on the profile of small caps. A much different picture over here. There is no spike from the Thursday session. Notice that value. I think most importantly, this would be the biggest takeaway on the session from small caps on Friday. Value is not overlapping to up as we breach in that early attempted breakout, as we've just noted multiple times on the hourly and daily time frame chart. If value was up here, if the point of control was up here, then that might be a different story. Maybe there was just this odd weak close, but indication was that price was accepting up here. That's different. But with value just inside the prior day's range and the high of day outside of that, to me, once again, it starts to indicate more of that failed breakout from small cap. So with that, let's jump back on over to the platform here. Let's reload the S&P 500 and let's start talking about our sectors. What do we see from a performance perspective? Who was losing? Who was leading? Who was losing? And where was the weight? There it is. We have ourselves healthcare at the tippity top of the list, up 2.41% on the week, followed by communications 2.39%, and then of course the Mac Daddy, we have the XLK, the tech sector, up 1.88%. Nice performance there, beating the S&P 500, which was up only, I shouldn't say only, but up 1.22%. Bottom end of the barrel, the laggards are the energy sector, down 2.57%, followed by bonds, not really a sector. But then, of course, we have the XLY discretionary. That's, not the best look up here. And I think primarily the reason behind this is that Tesla is not really participating in much of this bullish action. Amazon is, though, so a little surprised it's not counterbalanced for a bit more upside. Anyways, utilities at the bottom as well as materials. It looks to me to be more of a risk-on posture, and we'll see this through the ratio charts as well. Generally, the performance here this week does strike me as being bullish, with, once again, the tech sector here performing quite well. Let's check in on the individual structural charts. One thing that we can keep tabs on is, of course, this break of the resistance trend line, the move over this previous pivot from in here, the gap down open, which then sort of gave a little stutter step before the last final leg to the downside. So is there an opportunity for this to build out over the future, coming weeks? Sure, absolutely. For now, though, does it seem like it might be reasonable for a pullback still in a downtrend? I would think yes. The only way that you might not call this a downtrend, it's still a weekly downtrend, but the daily may have flipped to up if you want to count that as double bottom. Even if you don't want to count that as a high, which I would because there's definitely an hourly counter trend move there. So from here to here, you have higher high. From here to here, you sort of have equal low. Then from here to here, right, this is absolutely a higher high. So the possibility for a daily higher low here does strike me as being somewhat compelling. That's 140.80. We'll keep tabs on this. This is now the 4th heaviest weight sector by market cap. It's also D for defensive, so it would not be the end of the world if it does not participate via some sort of inverted head and shoulders. Next up, communications. Let's see what we've got. 5th heaviest weight sector by market cap. What do we see here? Nice break over the equal highs into the end of the week. Strong close on the Friday session. This chart to me looks bullish so long as we can stay outside of this balance range here, seek some sort of higher low over 99.15. No complaints about this chart here. This is helping the bull case for the S&P. The technology sector, it looks okay. The one thing I'm slightly concerned with about this is just the gap up over these equal highs did not result in a strong rally in the upward direction. I would think the opportunity here should have been gap up, gap fill reversal, and then rally higher. The only thing that's somewhat compelling, again, for the long side is very similar to the QQQ analysis, was just that on the Friday low of day, there was not much acceptance from the sellers to try to push prices through the gap. So very simple watch here. I would give this the benefit of the doubt, not even for the gap range, but the previous all-time high at 238. If we get consolidation here, really seeking Brigade bolts over time into blue sky territories over 242. That would be the bullish look for the market. If it just grinds around in range, I would have to probably take more of a patient stance in the S&P 500. If this were to happen in the XLK, you're probably dealing with a market that's pulling back anyhow, right? So we'll be looking for that higher low in the S&P 500 if this is the case, if we move beyond 238, right? Let's move along to the XLI. Industrials, really strong week. Just straight up here on a gap and go from Monday over this neckline right there. So no regard whatsoever for the potential lower high here from the weekly perspective, which means, right, this strong, straight shot in the upward direction basically gives the opportunity for a higher low now over 138.25, and we're right back in a bullish uptrend here. So these trends have changed quite rapidly on the weekly time frame charts. It was not a smooth process to reverse back to up. If we look at the XLF, we know that financial earnings from the banks really kicked this off on a strong note. Those gains are continuing to hold and digest sideways, even seeking continuation on the Friday session. So all things considered, once again, is it a shocker that the QQQ is lagging a little bit, whereas the S&P 500 is making those new record highs with financials clearly performing well? I mean, it's not a shock at all. Really strong looking chart here. Plenty of opportunity for a higher low. We are bullish on financials for that reason, so long as price is over 49.60. Next up, we have real estate, which of course is a lighter weight sector. It is interest rate sensitive. With all this talk about rates, I imagine that this moves quite rapidly this week. I would just keep a very close eye on this level right here, 42.70. If we reject underneath, not really the most bullish sentiment for real estate, and I would imagine that rates move back in the upward direction. Another thing to keep very close eye on is the XHB. Speaking of real estate and homes, let's talk about the builders and industry, of course. This continues to be a small, I wouldn't say like complete pain point for the market where, oh my goodness, we need to go out there and short the S&P with both hands. That's not how that works. But if this remains underneath, it would just continue to be a signal that the cyclical side of the economy is not doing well, which of course is totally reliant on that interest rate move, right? Which is why this aligns nicely with the XLRE, for example, and even the XLB down here. So with that understanding, just keep tabs on this. It's one of the bearish data points you could lean into if you're trying to build a bearish thesis. I think generally speaking, through all of the data points we've gathered so far, and we're only, about halfway through the video, I don't think you have enough bearish data points to stack up and say, oh my goodness, the market should be at zero or in a more aggressive daily downtrend. This is just one among the many we've seen so far, right, that are bullish, right, on the counter. So anyhow, keeping that in mind, 113.75 is your key level. Let's move along to consumer staples, right? Again, cyclical side of the economy, D for defensive, not the worst thing to see it lagging down here. If it can try to produce a little bit of that trend reversal like what we were seeing out of the XLV, we might try to call it a little bit, I don't want to say prematurely, right? There's a weekly lower high threat here for sure. But could we flip into a daily uptrend to get there? Absolutely, if we start getting acceptance over 77.50. It's a lighter weight sector, so let's move along to something much more important, like the semiconductors. Now, what I want to point out about the semiconductors, and we'll sort of see this in just a moment, a lot of the move, and let me know in the comment section if you've, leave the comment after you watch the fundamental take here, because you'll see how all of this threads together with the FOMC in just a moment. I'm really trying to make this point clear over the next couple of charts, right? Semiconductors gapped up big time on the Wednesday session with the release of this Stargate announcement, right? And there's a lot of speculation. Does SoftBank have the money? Do they not have the money? Does Altman have the money? Does he not? Right? We know that Satya from Microsoft has committed his $80 billion. We heard from Zuckerberg on, I think it was Friday morning, that he's committing $65 billion, and all of this is for AI infrastructure spend. So we'll see that. But is it going to be what the market expects is kind of the key question. And that gap up on the expectation, right? And this is the key, right? Expectation versus reality. The expectation is huge. If that misses basically, and we'll know that based on the chart, right? If we miss that expectation, if it starts to turn out like, SoftBank doesn't have the money, Altman doesn't have the money, these other two players, obviously Microsoft and Meta investing and all that money just gets funneled into NVIDIA anyhow, right? If those players have the money, then so be it. But if it's not the grand ambition that the market sort of saw from the headlines, this level will break and we'll be back in the balance range here going sideways, which is a big red flag for the market. Now, I'm not trying to say that. I'm not trying to say that this is the primary outcome we should be looking for. The primary outcome coming from the higher high in the trend count is that we should seek a higher low here first. We should look for a higher low at 256 to keep price over the top of the balance range. That's the first outcome. But if we see the deterioration out of semiconductors underneath 256, that's where we need to be extremely cautious in the S&P 500. This is all very closely related to what we'll see in just a minute with the valuation components coming from earnings outlooks as well as the PE multiples. So stick with me here for the next couple of charts. Let's rip through the remainder of the sectors and we'll get on over to it. Energy pulling back here is deflationary, so that's fine by me. Energy is a lightweight sector anyhow, so it's not going to move the needle. We'll watch this very closely. So far, it's just following the sine wave curve. We'll see if it continues. TLT ratio to the sorry, this is not ratio. This is just the TLT straight up. Still short the puts here at the 85 strike. I plan on holding those through the FOMC. Just as an FYI, I'll always sort of be transparent when I'm holding a position. So there's that. To me, it's possible that maybe you get a little bit of inverted head and shoulders. However, I think that this could easily just evaporate, right? I would not put that pattern ahead of Jerome Powell and say, oh, why didn't the pattern hold, right? So far, so good, and rates are backing off, and it really depends on what we think about inflation. With energy backing down a little bit, to me, the perception should be that inflation comes in a little bit light relative to the last report, because we know that shelter inflation was basically flat, and the big contributor to CPI just a couple of weeks ago was energy, right? Which is volatile anyhow, and it makes sense going into the winter season. So with what we just saw out of the XLE pulling back off the top end of its range, if you look at something like crude as well, let's go CL, right? Crude pulling back sharply here. We could even take a look at natural gas is kind of holding up. And it's in an uptrend, so we'll keep tabs on that, but it's off the highs, the local highs at least, so we'll continue to monitor. But generally, what does it mean? Why is this important for the conversation about the TLT? If inflation subsides a little bit and the labor market, it's not breaking completely, but we're starting to see initial jobless claims come in over the expectations, right? Then maybe the Fed does take a little bit more of that dovish stance, and we hear from Powell on Wednesday that maybe there is a little bit more of that opportunity to cut rates sooner than we thought, or like maybe we're thinking more so about that, right? In which case bonds will catch a little bit of a bid, interest rates will fall, of course, and that keeps the 85 short puts fine. If we move through 85, if that gets assignment, again, this position is sized appropriately, where I'm glad to take assignment of shares here at 85, right? No problem there. Taking my assignment. So anyhow, that's the analysis. Those are the key levels, 87, 86, 25, kind of that key right shoulder build out in here. And that's the commentary from the fundamental perspective. Discretionary, putting in the sideways chop, really because of what's going on with Tesla primarily, not playing nice with this rally we've seen. Nonetheless, from a trend perspective, certainly putting in consolidation over the lower box, which is a step in the right direction. So as long as price holds over 227.50, good to go. I mean, it's trying to build out a new uptrend. You could go out on a limb and say like left, head, right shoulder, maybe, right? There's definitely a break of a resistance trend line here from this anchor to this to in here, right? So definitely trying to change back to bullish. This is a heavier weight risk on sector anyhow. Utilities, lightweight and risk off. No complaints in here. Midpoint of the balance range. Nothing to comment from that perspective. XLB, like materials, like like real estate, like home builders, strong counter trend move so far off of the lows here, but still a weekly lower high opportunity in there around 91 basically. It's such a lightweight sector. It's not going to make or break the S&P. So let's jump into our ratio grid. And let's see what we can see here. This, I was honestly hoping for a little bit more of a continued outperformance from the tech sector, which we just had that conversation anyhow from the structural chart. And we talked about that gap up that should have provided a gap fill reversal. Didn't happen. So a little, I wouldn't say on edge. I'm not bearish about this chart, but it's not really getting the follow through I would have liked to see. If it can catch for a higher low, maybe we'll give it a second chance. This wants to perk up. I think we have the opportunity for both of these things to take place if big earnings this week follow through properly. Obviously, financials look great, and we know that from the structural chart itself. We've been watching JP Morgan, looks really strong there at all-time highs. Discretionary, we already talked about. This is a non-issue. Risk-off sectors are a non-issue. Risk-off sectors are a non-issue. Let's move on into the individualized sectors. Let's grab this in here. Sorry, some specialized ratios, basically. And by the way, if you don't know how to set up a ratio chart in Thinkorswim, check out the video tutorial in the top right-hand corner. The XLK looks, better. We've talked about the improvements that were made during the ascent through this move in here, this move in here. Now it's just a matter of whether or not these things can hold, right? So I would love to see now that we've produced basically an equal high, even somewhat of a higher high if you want to split hairs there, I'd love to see a higher low. That starts to change the tone to continuing to remain risk on. Same thing over here now that we got back, above the 50 SMA. This one not as sold though on the idea, primarily coming from this sort of look there. This still looks risk on, and this looks risk on as well with the opportunity for a higher low over an upward sloping 50 SMA. Let's get on over to the Japanese yen. Everybody, panicked about, oh my God, the Bank of Japan's going to raise rates on Thursday night. We're going to wake up to a bloodbath on Friday. They raised rates. It was well within the expectation. Remember, we talked about this. You can go back. You can listen to the timestamps, right? Go back to the Wednesday video when we talked about it. As long as the market got exactly what the market priced in, which was 25 basis points worth of hikes, it didn't matter. It was going to be a non-issue. It was if they issued a jumbo hike, which was going to be a 50 basis point hike from the Bank of Japan, where we would say, yeah, look out below. Things are not going to go smoothly. The market's not expecting that. So we got the expectation. It was telegraphed for like weeks and weeks in advance. Non-issue out of the yen carry trade over here. Let's continue along. Speaking of currencies, to take a look at the dollar, a little bit of a pullback happening here. This is a weekly chart. Let's actually flip this to this view. This will give us a daily time frame chart. The reason I wanted to bring up the daily is because the weekly looks like it can see continuation, but the Friday breakdown was actually fairly impressive and noteworthy, seeing that it moved underneath this big shelf of support from in here at 107.50. So on the smaller time frames, you're absolutely getting a little bit of a breakdown in trend, which is typically good for S&P earnings estimates walking forward. So interesting to see how this maybe impacts forward guidance through the reports that we're going to get this week, and obviously trailing out for next week and into the end of the month and early February, of course. The TNX is linked down below here, and of course the conversation we already had with the TLT, it's the exact inverse, right, where we have these things. We know energy is coming down if inflation is going to be a non-issue, and we know that the Fed is starting to pay closer attention to the labor market, and we'll know this in the Q&A press conference from Powell, right? Based on the way he answers these questions, he's either going to sort of telegraph, yeah, we're paying close attention to the labor market, and we don't want to see things get worse. Inflation's doing fine, let's not worry about that, right? If he takes that stance, it's a clear indication of a dovish stance, in which case we should probably look for the 10-year to back off a little bit, right? Which means that the dollar should also come down a little bit, which means that earnings can probably see a little bit more expansion from the S&P 500. And again, stick with me here because it's all going to make sense in a brief moment. Let's check in on gold. There's a lot of commentary about gold potentially looking like it's signaling like there's a warning out there. I'm not seeing it. And the easiest way to see it is just look at the ratio chart, right? We set this up for a reason. We don't just look at gold in isolation. Is it like, are market participants flocking into gold because they're fearful of inflation round two? Yes, there's an uptrend here, but if that was the case, then equities would not be performing as well, and this ratio would be making new highs, right? And that's just not what we have currently. It's look at this, right? Look at the divergence. It's very clean. You have lower highs being produced, where higher highs are being produced up here. Is there a flight to safety in gold? I'm not seeing it. I mean, please take the blindfold off for me in the comments section. Tell me what I'm missing here, but I don't see it. Not seeing it in gold. Let's move along to, we talked about interest rates, so let's get into the inverted ZT, which is basically the 2-year. It's been backing off, so that rate hike is, probably moving further and further away from becoming a reality. We were a little more concerned with that as it started to look like we were breaching the 102 handle. Obviously, that's an inverted chart, so breaking down underneath technically. But let's move on over to the Fed tracker tool. Let's talk about these fundamentals and hopefully tie everything together that we've been alluding to and hinting to so far. Here we go. Very, very probable that on Wednesday, and nobody should be shocked about this, that the Fed does absolutely nothing with the interest rate. Obviously, there's a 97.9% chance that nothing happens, right? So the Fed, I can't even count on one hand. I don't even need one hand to count the number of times where the Fed has surprised the market, right? So we're all set here. We're not worried about what they do. It's about what they say. And what they say has the power to influence what this column looks like on Wednesday. If this column shifts this way, then of course that's more hawkish. That's, now we're, higher for longer looks good. We're not worried about the labor market at all. Inflation's coming down, or maybe inflation's not really coming down. It's stagnating. We want to keep rates higher for longer. We want to put the nail in the coffin. You're going to see this move to the right. And the reason that this is important, and again, I said it in the introduction, we need to watch the expectations from the Fed walking forward, because this has a pure correlation to what we see over here. I'm going to skip ahead to earnings insight, and then we'll go back and we'll talk about the economic calendar in just a second. But look at this. I want to make the point. I don't want to sort of belabor it anymore. Look at what happened into the end of the week with earnings expectations from a bottom-up perspective going into calendar year 2025, right? On both counts. Not just the end of year here for 2024, the final quarter, right, gets reported and, we're expecting a little bit of a downtick. No, this is for the upcoming calendar year, the calendar year we're in right now, as well. And yet the market has rallied in the upward direction. Now, a comment here before we get too deep into the fundamental analysis and all of a sudden get all bared up and, oh my God, the market's got to crash and go to zero. Price is what pays. We do the technicals first because I believe you should be making the trading decisions off of the technical chart. The fundamental backdrop here might be some supporting evidence for the environment that we're trading in. Now that I've shown you that earnings have come off of a cliff here, if I move to the downside, we can see that to make up for that, the market has done what? The market has rallied based on a multiple expansion. And what do we have coming up this week? A Fed who has the possibility to say that, no, we want to be tough on inflation. The labor market, yeah, we're paying attention to it, but it's not a big deal. I really think that they're going to take that approach. Why do I think they're going to take that approach? Let's look over here, right? As we look at, let's just open this one up. It'll be fine. This is the jobless claims, right? We are seeing a little bit of an uptick here. But have we done anything that makes the Fed say, oh my goodness, the month-over-month unemployment rate is going to move to like a 4.4, a 4.5, it's going to be ugly, right? Are we dealing with an unemployment recession looming on the horizon? The answer is absolutely not. Although these have missed the expectation, they're well within the bounds of relatively recent moves from unemployment. So is the Fed going to be overly concerned about the labor market? I don't think so. I really don't think so. And if we think about what's going on with inflation, I think they want to keep the battle strong over there. This is the monthly PCE on the core front. If I just fire up this tab, we should have the year over year. Yeah, so this is year over year. It's at 2.8. And 2.8 is not the Fed's target, as we all know, of 2%. And we've talked about in last weekend's update, if we just jump over to this chart real quick, right? It's very unlikely that the Fed is going to get back down to a 2%. Let's get back to CPI non-core here, right? It's unlikely, right, in a non-ZERP environment that we're going back to sub 2% on the inflation front. So I think the Fed's going to play hardball with inflation and say, we're just going to find that higher neutral rate. The market needs to find a higher neutral rate. So again, how does this all tie together? If we go back over here and if we look at this multiple expansion, if rates stay higher for longer, if we don't go to a zero interest rate policy, why would we have a PE multiple that's up here, right? So if I think about how does this influence the trade this upcoming week, I think it just supports the idea that the market is running on fumes towards the high. If Jerome Powell has any even small hint of being hawkish, I think a pullback is very reasonable, right? That's all of this in a nutshell. I do just want to point out once again, here is the Bank of Japan. The decision down here, highly anticipated to go from a 25 basis points to a 50 basis points. That was the consensus. That's exactly what we got. The market didn't panic. I think that they'll likely have to continue hiking interest rates, so it's a theme that we'll continue keeping tabs on. The reason for that is what we have up here. The inflation rate continues to tick aggressively in the upward direction, right? You saw a miss out of the core rate at a 3% versus the forecast here at a 2.9 from, I think it's Trading Economics, right, is where this forecast comes from. Anyhow, that's the fundamental. This is the economic calendar, right? We know it's all about Wednesday, 2 o'clock. Is Powell a dove or is he a hawk? And that will influence our market. And we'll keep very close tabs on how the probabilities change for the market moving forward, because this easily has the opportunity to erase the multiple expansion rally that we have seen so far. If we look at sort of the final projection down here, I thought that this is an interesting thing. This is the final basically for 2026, going out 2 years now. Notice that that's 350 by 375. If we take a look at the FOMC's SEP, Summary of Economic Projections, the SEP outlines a 3.4, which is more rate cuts than what the Fed tracker tool is pricing in so far, right? So the market's already got sort of a hawkish stance on what's going on. Anything that exacerbates that on Wednesday really gets dangerous for, again, I think that pullback becoming a reality. And again, technicals rule in terms of making the trade come to life, but the backdrop would align with that, right? Here we go. This is the earnings calendar. Too many names to call out every single one. So obviously this is really your heavy hitting day, Wednesday, but there's a number of things here that you could probably pay attention to and pick up some decent market insights from. Apple gets a little bit of love here on Thursday after the close. Also watch out for Visa. Visa and MasterCard are now included, not in the XLK, but in the XLF financial sector there. All right. That is what we have on the calendar. Let's get back on over to the platform here. Let's finish up our technical take with some of the additional risk appetite indications, TLT ratio to the S&P now, continuing to make a lower low. We were starting to note the character change over here with the equal lows. With the lower low now, you better bet your bottom dollar there's no flight to safety taking place in the TLT. If we look at bonds relative to themselves, there's the opportunity maybe for short-term lower highs. If that's the case and we make lower lows, I would be a little bit more optimistic about Jerome Powell taking the dovish stance. If these do not, if this catches early in the week and makes equal highs, probably dealing with more of the hawkish stance from Jerome Powell. This speaks directly to inflation expectations to some degree. Let's take a look at credit spreads. We have rolling over, volatility compressing. I don't know that I believe that. I think that to me, it's more of a risk on indication, less of a volatility indication seeing these lower. I think there are too many catalysts for volatility this week, personally. If we look at the HYG in isolation, confirming the higher high here, all set. This is bullish. We could swap out for the LQD real quick. And what do we see out of corporate grade? It's staying over the key level, which aligns with the S&P trying to move higher. It would be ideal if this could break for a higher high and make the equal high closer to like the 110.25 handle. Let's move along to the BTC. There it is. Crypto continues to look pretty good, still firing that bullish signal from the Sailor Shift tool. You could check that out on the website if you're not familiar with it. And generally speaking, no issues. This in total would speak to a risk on appetite, right? And we talked about this with the whole Trump coin and the Melania coin thing. You know, aside from how you feel about what the influence that has over crypto and, you know, regulation, was it a good thing, was it a bad thing? It doesn't matter, right? I mean, it matters at some point, but that's not the point of why we're here. It speaks directly to risk appetite. If everybody was like scrounging for their last pennies to go pay rent, if you were strapped to go buy, you know, groceries or whatever, nobody would be dumping money into Trump coin, Melania coin, all these things. I mean, yeah, the prospect of making money is nice, but at the end of the day, and maybe I'm just living in too old of a world, but I believe that people would probably prioritize paying rent than dumping some money into a meme coin. I feel like a lot of people don't even know how to do that. So anyhow, some distortions from crypto, but generally still continuing to represent risk appetite being elevated for the market as a whole. People are optimistic here. If we look at total breadth, we can see, and the main difference I want to draw here is just that the 50 SMA, the blue moving average, set a lower high underneath the 50% mark, versus over here, we technically closed above on the Friday session. That is a little bit more bullish than it is bearish. It does not appear as though we are going to have a breadth contraction sort of drawdown in the market. If we look at, let's move on over to the RSP and see what else we can learn about breadth. No problems, plenty of higher low opportunities over 178. The consolidation looks good. I will just make note of the failed breakout on the Friday high session. That's fine. It's not a cause for concern. It's not an, oh my goodness, short the market. It's just pay attention, right? Same thing out of the QQQE. Looking for that higher low over the top end of the range. Breadth so far is moving appropriately in the upward direction. Same thing here out of transports versus industrials, trying to play catch up, but still looking out for that 17,000 mark. Let's move into some volatility indications. The VIX is dead, sure thing. Does not really look like it's telling us all that much. So let's move into the VVIX, of course. Volatility of volatility. It remains somewhat elevated near the 103. I think in a stronger or less on-edge market, you would see this continue to trickle lower, especially as the advance took place into the end of the week. And in my view, this really just aligns with everything we've said so far in today's episode, that we're not really trustworthy, or we're not trusting of, excuse me, I should frame it that way, the S&P 500 weekly expected move, right? The VVIX is like, no, we're still elevated here. If we take a look at volatility futures and whether or not these are in contangos and backwardations, I really love this chart. Man, this thing is, it makes me excited bringing it up here. Don't clip that. What do we have? I mean, we've got everything in contango. There's no divergence. There's no inversion here from the proper timing of the spreads. Everything is the way it should be. So in theory, I mean, money managers, are having the time of their lives. It's like the time to allocate capital, absolutely, right? So I don't think we want to underestimate that intraday volatility works in both directions, right? This is not an indication that it's a panicked volatility. Oh my goodness, we're going to dial back capital allocation. There's definitely going to be capital allocation under this circumstance. However, volatility, in my opinion, from a catalyst perspective, cuts in both directions, right? We could easily just breach the upper edge of the weekly expected move, no problem, and find price, I'm drawing an extreme exaggeration here, but 625, right? 650, who knows? Get crazy, 700, right? Obviously not, but you catch my drift, right? Volatility cuts both ways intraday. So with that, we are moving into the core list of companies. Actually, my apologies, we're not, because there's an additional chart here that I need to share with you. Let's go and take a look at the skew, right? Skew is worth talking about because it just produced a brand new high. I think this is a record high, if I'm being quite frank here. Let's see if we can grab max time frame. How do I do this? What am I looking for? Let's just set it to a monthly. Let's just grab max time this way. And I just want to double check I'm not leading you astray. Yeah, look at that. Brand new record high out of the skew as of the close from Friday's session. So what does this mean? It means that a lot of people are picking up on sort of what I'm picking up on, that, hey, there's a lot of volatility coming down the pipeline with earnings, with the FOMC, and people are hedging their bets. People are absolutely hedging their bets. Now, of course, the hope is that those hedges just go to zero and the market continues in the upward direction. That's fine. But the skew at least is telling us that people are somewhat on edge, right? People are on edge. They're uncertain about this continuation in the upward direction, which, you could make the inverse argument and just say, hey, it means we're going to continue to climb the wall of worry. Let's get through the core list of companies now. And some of these have earnings. We'll give you the earnings spiel in just a second. What do we have out of NVIDIA? It remains inside of this balance range. It's near the midpoint of the balance range. I am going to maintain the stance that the 140 zone is kind of the higher low zone that I'm looking for. It's the daily 50 SMA. I'm torn here because we do have a bearish engulfer on the Friday session, opening on that gap up, fading the entire gap, closing underneath the 2-day balance range. If we look at the hourly time frame chart, right, this is just nonstop selling from NVIDIA. It stopped directly at the gap close. And my intuition here tells me, the daily trend is kind of neutral, so dial back your aggression, your desire to sort of pick up a big new money long on this higher low. Structurally, would it make sense? Is this the proper zone for a higher low to be produced? Yes. But again, my intuition here, just keeping, let's go back to a full screen daily. My intuition in the daily range is just, we're in a different world now out of NVIDIA. And it's not to say that that world can't change, but I think the reality that not many people are accepting is just like, NVIDIA is not doing this anymore or doing this anymore, right? It's one day at a time. It's kind of a grind in this zone. If it was going to sort of see this big pickup, like why was it not in here, right? This sort of big bearish move on the all-time high gap up sort of put some of that to bed in terms of looking for that continuation. It no longer really just mirrored some sort of like weekly bull flag looking for the breakout, much more of a balance range now. So again, I think this zone in general is very important. It's a key hold for NVIDIA, but are my expectations going forward for like this huge, multi-100% rally? Probably not. Probably not at this point, right? So that's not to say that you can't get something more similar to this. Let's not forget about this, right? So balance ranges can resolve in particular directions, but this is early stage AI, right? Or I shouldn't say early stage AI. Goodness, that would be like the 50s. But this is early stage, like GPUs need to be maximized. Oh my goodness, NVIDIA is the place to be. They're going to get everybody's revenue, from Microsoft to Meta to anybody training a model, right? So anyhow, some thoughts about NVIDIA there. 140, it's the key level. Do with that what you will. Let's move along to Microsoft. Earnings this week will be influential. So here is the spiel. Stick with me as I pop on this drawing set right here, or I should say, it's not a drawing set, it's a study set. Implied volatility is going to crush the value of options if you trade short-dated options expiring within the range of your earnings announcement. So, do I have any grand ambitions of trading pumped-up implied volatility through these releases? Probably not, right? This isn't so bad. 35 is actually not so bad. Typically, like 80, 75, that's where you want to stay away. Excuse me. We'll see if We'll see if that changes early on in the week, but if this gets up to 80.75, I don't have big plans of trading Microsoft ahead of earnings. It's just not in the cards, right? You get burned on that too many times with that IV crush coming up, or just like the bang for your buck isn't there. So we're only going to do the spiel once here on Microsoft, but you get the idea. Trading pumped up options IV is no good. We could take a look at Amazon just to gauge its implied volatility a little bit higher at 60. We could take a look at Tesla. Tesla's much, not much higher, but 62. Implied volatility out of Tesla. Who else is reporting earnings? Let's go back over Meta, and we could take a look at, let's just stick with Meta. We'll keep it simple here through the core list. There it is, Meta. Meta trading at a 76 vol, right? So staying away from these things, at least in the short-dated options expiration, is probably going to be beneficial, right? Making a big call with IV pumped up is no good. It's a losing battle, right? If you've been there and if you know the outcomes, right, you know not to mess with that stuff. So anyhow, that's my blanket statement take for earnings. The technical chart here out of Microsoft, it does look bullish with inside bars printing in the upper 50% of the Wednesday breakout to the upside. Nice holds as well of the top end of the previous balance and also the lows from here, highs from here. So 441.25 is absolutely a key level. If we can seek continuation, then awesome. You could trade it as like an hourly bull flag. That's great. But one more time, keep in mind, you need to do this with respect to earnings. Doesn't matter how good the chart setup looks. If earnings don't allow you to take the proper contract, you're going to get burnt on it anyways, even if you're correct, right? So just understand that. Make sure you're either using the correct contract, which is going to be way further out in time, or you're just simply trading shares, where the Greeks are not a problem at all, okay? Let's move along to Apple. Apple, of course, has earnings as well this week, Thursday after the close. Not really the best outcome we were thinking of for this gap close overhead. It was a very lackluster gap close. I think that the chart is undoubtedly bearish on this big failed breakout happening here. Plenty of room for a weekly lower high underneath the level in the zone around 234.55. Not really seeing anything compelling out of Apple, to be quite frank. I mean, maybe you could say we're at the bottom end of this prior range. It's time to start looking for that counter trend move off the 200. That should have been on Thursday. Right, that really should have been on Thursday. If it was going to go, it should have went. Didn't really get that follow through, right? So here it is on the intraday. Opened, got the nice move to start moving through the gap, and then faded off again, even with the move to open higher on that Friday session. So not thrilled with Apple, thinking that it's much more of a wait for earnings to pass style play, and then we'll reevaluate after that. Amazon, what's going on with Nancy? Just, the chart of the week. Absolutely the chart of the week, breaking out of the bull flag, gap fill reversal on Tuesday, Wednesday gap fill reversal, Thursday much more balanced, Friday not really getting in gear over the two equal highs, but still setting up for a potential continuation play as long as price can stay above 232.50. Earnings on this one a little bit further out, non-issue for this upcoming week. So it will be in focus for that reason. On the hourly chart, it's quite clear, right? You're just dealing with a range. Keep it simple. You're either here. If you want to take the short, be my guest. I would be more interested in potential retest entry longs off of 228.75. Moving along to Google. Google is more of a short, in my opinion, and it's been that way for a little while in the short term. Again, we sort of need to draw the comparison between the weekly, cup and handle. I get it, right? That's bullish. You could call this a bull flag. That's fine. You could say it's staying over the previous pivot high. That's great. But on the short term, Google has really failed to participate in much of the upside that we've seen out of for example, you're actually not, I guess Meta comes to mind, Amazon comes to mind, and it's not really in those categories. So I suppose with Microsoft more sideways, this might make a little bit of sense. But regardless, the point being on the hourly is if you take a look back here, I mean, failed, closed back down underneath in the, all of these sessions closed underneath, and only on the Friday session was there some sort of rally to get back over that 198.85. So taking this day by day, the approach I've been a big fan of, right? And you can go back, you can watch the pre-market live streams, you can listen back to old videos, right? If the broad market is bearish, then we will trade Google downside for this. It looks like the name to look for, just noting that continued struggle near the all-time high, all right? So one more time, the emphasis on the if the broad market is bearish, this is where we look, right? Next up is the metaverse. Let's see what's going on with the Zuck and his commitment for, I think it was $65 billion to AI infrastructure. Nice rally, brand new all-time highs on Friday. Really strong move there intraday. Look at the push off of the open, and then nice consolidation high and tight into the afternoon. So very clean chart to watch going forward. Obviously be respectful of earnings, but if it could support higher lows over 635.25, that's beautiful. Looking for continuation. Tesla up next, the laggard of the crew, right? we can see the continued rejections and struggle around 415, previous all-time high, the dotted line going off to the left. If we go down to the hourly time frame chart, one of the things that we've been sort of mindful of is this head and shoulders. Now, we have not definitively seen like acceleration under the neckline, but we did close below on Friday. There's one thing I would be very interested in trading here, and it's the failure pattern, right? The failures out of Tesla tend to be some of the stronger moves. If the sellers fail to accelerate price in the downward direction underneath 410.25, the neckline, any recaptures of that level and subsequent breaks over 415, I believe should bring price up towards 426.85 quite rapidly. So that's the idea. If it wants to happen on Monday, maybe Tuesday, we'll entertain it. But one more time, use the proper dated options. Do not, fall victim to trading something with incredibly high implied volatility. You will get burnt, right? The premiums will not move the way you're expecting them to. Let's move along to JP Morgan. What do we see over here? Plenty of room for a higher low. This is just like up and away. Thank you to Mr. Demon, Mr. Diamond. There we go. It looks great. Chart looks great. Plenty of room for a higher low. Consolidate up here. Brigade bolts, daily or hourly bull flag, good to go. I would say if it moves underneath this 260.60 mark, here it is on the hourly so you can see that. If we move underneath this, there might be more of an opportunity for like a balance range to form on the daily. But I would still generally, obviously maintain the stance that this isn't an uptrend as long as higher lows are over 248. Next up, Netflix, and then I have two trade ideas to share with you, and you're on your way for this lovely Saturday evening. What do we have? Just inside bars relative to the gap up from earnings. We all know what happens with earnings on this one, right? Let me go back out to a month approach here. Earnings consolidation, rally. Earnings, this was a gap down through this cycle back here through the summer, but then rally, right? What do we have here? Consolidation after the gap up, rally. I'm not saying it needs to play out the exact same way, but my goodness, would it make sense if Netflix put in some consolidation and then saw a big breakout over 1,000? Count me in. From a risk reward perspective, sure, there's probably some sort of risk there that we could set up for reward to the upside, doubling the balance range. I'm very interested in that possible trade. So watching this very closely here on Netflix. Two trade ideas, and then we are done. ORCL, Larry Ellison, also committing a decent amount to that Stargate project. So Oracle, big move higher here and here, of course. But if that's going to come as a it's a nothing burger and none of that's going to come to fruition, Larry probably has the money here with Oracle, unlike maybe Mr. Altman and SoftBank. We'll see. But this gap close is potentially interesting. If this whole thing was blown out of proportion, if it's like, oh my goodness, the Stargate announcement and, all these big key players involved, if that fizzles out, if we start to see, a lack of confidence in that project, if Elon Musk, continues to post on X that like, hey, these guys don't have the money, like just look at the balance sheet, right? If that continues to be the case, then I would not be shocked to see something like this. It doesn't have to give back the entirety of the move down to 165, but a gap close here is very interesting after just a 3-day balance, post-announcement there. So anyways, 181.80. If we break down underneath, seeking that 173.35 gap close, and then we'll reevaluate when and if we get there. This is another one of these charts where you probably want to see the if statement apply with the broad market. You take this trade if the broad market is also, offering that pullback. The next one, bullish, GILD, Gilead. What do we see over here? Beautiful range, nothing but just, very, very equal highs all throughout this entire test. Friday's bar is not the most convincing inverted hammer, a little bit more of an upper wick there, but the clean breakout level just makes this very interesting to me. It's the improper end of the auction. If we could find some sort of Brigade bolt on like a 5 or 15 minute chart above 94.15, oops, missed, 94.15, 98 as a target makes a lot of sense. This is a pretty thin range back during this breakdown here, and that, I believe, let me double check so I'm not misleading you. We want more time, not less time there. I want to just double check that it's an all-time high. Let me just double check here. I know with some of these, like obviously PFE and mRNA are well off of their highs, but I'm not quite as familiar with Gilead. Let's just go out to a weekly chart here. Not an all-time high, so it's a good thing I checked, right? Anyways, all-time highs back up here at let's call it 23 for round number's sake. Regardless, where's this pivot? That's up here at like 103, 102.50s. Let's say 102.50s on that. Not really a concern for this particular trade idea that we were looking for. And once again, just trying to, properly walk through all of the steps and make sure nothing's misleading about this setup. Nice uptrend behind us. If it can breach these highs, looking for that 98, right? And that's it, right? And I guess one last thing you could say about this is just generally the higher lows want to continue here, building out some sort of ascending triangle into the level for that breakout to have a higher probability of ultimately unfolding. That's going to do it for this weekend's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Another way you could let me know that you made it to this point or you watched the core chunk of that video is just by talking about the fundamental, PE expansion, right, relative to the possibility of a hawkish Fed who's still going to maintain the stance of like, no, and also just here's a final comment, we're not playing sides here, but just in terms of Jerome Powell and his relationship with the administration, right? It's kind of ironic because the previous Trump administration put him into his position. Now they sort of like want him out of there. I think Powell is going to be very firm in his approach to say like, no, the Fed is independent from the administration. We are going to make our own decisions based on the totality of the data. And as of right now, it indicates that we need a higher neutral rate, right? That's basically what the bond market is saying anyways. But I would look for some of that tension to resolve on the Wednesday session. So it should be very, very interesting. Big catalyst here this week. We'll stream it live on the channel. Hope to see you there. We'll probably kick it off at like 1:45, 1:50 Eastern time. We'll get the result, which is unchanged, and then we'll stream the Q&A as well. Okay, so those are my final thoughts. Again, appreciate you coming out to the show. Hope you have a green trading week, and I will see you in the next one.